If you look at the U.S. national debt clock today, you see a number so large it feels abstract. More than $35 trillion, accelerating toward 38, a figure so massive that most people stop trying to understand it. Politicians tell you not to worry. Economists say it is manageable. Commentators argue over whether deficits matter. But all of that misses the point. The real danger is not the size of the debt. The real danger is how often it has to be refinanced and at what cost. The United States does not owe $38 trillion all at once. It owes it in layers, in maturities, in rolling obligations that constantly come due. And that structure is what turns a big number into a live risk. Here's the part almost nobody explains clearly. U.S. government debt works like a massive adjustable rate mortgage. Treasury bills mature in weeks or months. Treasury notes mature in 2, 3, 5, 7, or 10 years. Bonds mature in 30 years. Every year, trillions of dollars of existing debt expire and must be refinanced at whatever interest rate the market demands at that moment. This is called rollover risk, and rollover risk is where the system becomes fragile. For decades, this risk was invisible. Interest rates were falling or near zero. Refinancing old debt was cheap. The government could issue new bonds at lower rates and reduce its interest burden even as total debt rose. That era is over. Rates are no longer near zero. Even if they fall modestly, they are structurally higher than they were during the 2010s. That single change transforms the debt from a background statistic into a budget-consuming force. In 2024, something historic happened. For the first time, net interest payments on the federal debt surpassed national defense spending. This is not a talking point. It is a budget fact. Interest is no longer a passive line item. It is one of the largest expenses the government has. And unlike defense or infrastructure, interest produces nothing. It does not build roads. It does not fund research. It does not deter adversaries. It is the cost of past decisions, paid to bondholders for money already spent. This creates a compounding problem. As more debt rolls over at higher rates, interest costs rise automatically. Even if Congress froze spending tomorrow, interest expenses would continue climbing because old low-rate debt is constantly replaced with higher-rate debt. That is the trap. The government does not need to spend more to spend more. It only needs rates to stay elevated. To understand why this matters, imagine a household with a massive credit card balance but a teaser rate that keeps resetting higher. The family does not increase spending, but every year, more of their income goes toward interest instead of essentials. Eventually, something breaks. Either income rises dramatically, spending is cut brutally, or the debt is inflated away. Governments face the same math, but with political constraints layered on top. Unlike a household, the U.S. government cannot easily cut spending. The majority of federal outlays are mandatory. Social Security, Medicare, Medicaid, veterans benefits, and interest itself are locked in by law and demographics. An aging population guarantees rising costs. Cutting these programs is politically radioactive. Any serious attempt ends careers. That leaves a shrinking portion of the budget as discretionary. Defense, infrastructure, education. Cutting those does not solve the problem. It weakens the country while leaving the core math unchanged. Raising taxes is also limited. To meaningfully offset interest growth, tax increases would need to be large and sustained. History shows that aggressive tax hikes slow growth, reduce revenue efficiency, and trigger political backlash. The United States is not struck. Once you understand that the real risk is refinancing, the next logical question becomes unavoidable. Who is actually buying the debt when it rolls over? This is where the story becomes uncomfortable, because the answer today is very different from the story most people still believe. For decades, Americans were told a comforting narrative. The world needs dollars. Foreign governments are happy to hold U.S. treasuries. Global demand for U.S. debt is endless. As long as the dollar is the reserve currency, the United States can borrow cheaply forever. That story was never entirely true, but it was close enough to function. Today, it is breaking down. Let's start with the basic structure. Every year, the U.S. Treasury must issue trillions of dollars in new debt. Some of it funds current deficits. Most of it refinances existing obligations coming due. These bonds are sold at auctions. The buyers fall into four broad categories: foreign governments and central banks, domestic banks and financial institutions, investment funds and money market vehicles, and finally, the Federal Reserve, directly or indirectly. For most of the past 40 years, foreign buyers played a central role. Countries running trade surpluses with the United States accumulated dollars and recycled them into treasuries. China, Japan, oil exporters, and export-driven economies became major holders. This helped suppress yields and made refinancing painless. But that trend has reversed. Foreign ownership of U.S. treasuries has been flat to declining for years in real terms. China has reduced its holdings significantly from peak levels. Japan has stabilized, but is no longer a growing buyer. Sanctions risk, currency volatility, and domestic funding needs have changed incentives. Foreign demand is no longer the automatic backstop it once was. That leaves domestic buyers. U.S. banks, insurance companies, pension funds, and asset managers now absorb a much larger share of issuance. But here is the critical detail most people miss. These buyers are not acting in a free market. They are constrained by regulation. Treasuries are designated as high-quality liquid assets. Banks are required to hold them to meet liquidity coverage ratios. Insurance companies face capital charges that favor government bonds. Pension funds are steered toward treasuries by risk-weighting rules. This creates a captive buyer base. Demand exists not because treasuries are attractive, but because holding them is mandatory to operate legally. This matters because captive demand is not elastic. It does not respond smoothly to price or yield changes. When issuance rises faster than balance sheets can absorb, pressure builds quickly. That pressure shows up in auction tails, rising term premiums, and volatility. The market does not quietly adjust. It lurches. Then there is the role of money market funds. These vehicles have grown explosively as rates rose. They park cash in short-term treasury bills and overnight facilities. This has helped absorb short-dated issuance, but it creates its own vulnerability. Money market funds are rate-sensitive and maturity-sensitive. They can rotate out quickly if conditions change. They are not stable, long-duration buyers, which brings us to the final buyer, the Federal Reserve. Officially, the Fed does not fund government spending. In practice, it plays a critical stabilizing role whenever private demand falters. When markets demand higher yields, the Fed can intervene through balance sheet operations, repo facilities, or signaling. This does not require overt quantitative easing announcements. Liquidity can be injected quietly through standing facilities, collateral adjustments, and temporary operations. This is where fiscal dominance emerges. In a world of low debt, the Fed could prioritize inflation control even if it caused fiscal stress. In a world of massive rollover needs, that independence erodes. If yields rise too far, interest costs explode. Auctions weaken, financial conditions tighten abruptly. The political pressure becomes intense. The Fed does not need to be told what to do. The structure itself constrains its choices. This is not theoretical. You can see it in the data. Despite persistent inflation pressures, real interest rates remain historically low relative to debt levels. Despite record issuance, auctions are supported. Despite foreign pullback, funding continues. This stability is not natural, it is managed. The danger is not that buyers disappear overnight. The danger is that the marginal buyer becomes increasingly price sensitive. Each additional trillion requires more inducement, higher yields, regulatory pressure, central bank accommodation. Over time, this changes the nature of the market. Once the buyer base shifts and refinancing becomes the central risk, the system enters what can only be described as an interest trap. This is the point where debt no longer behaves like a passive stock, but like an active force that dictates policy. The trap is simple in structure and brutal in consequence. Higher interest rates increase interest costs. Higher interest costs expand deficits. Larger deficits require more borrowing. More borrowing increases refinancing exposure. And that exposure makes high rates politically and financially intolerable. The system begins to fight itself. To understand the scale of this problem, you need to stop thinking in percentages and start thinking in cash flows. A 1% increase in average borrowing costs on $38 trillion is not a rounding error. It is hundreds of billions of dollars per year. That money must come from somewhere. It is not optional. It is legally owed. And it arrives before any discretionary spending decisions are made. This is why interest has quietly become one of the fastest growing components of the federal budget. It grows automatically. Congress does not vote on it. Voters cannot block it. It compounds in the background. Every bond issued at a higher yield locks in future obligations that persist for years. Even if rates fall later, the damage is done. The interest bill reflects past issuance, not current conditions. This is where the refinancing calendar becomes dangerous. Large portions of U.S. debt mature within short time frames. Treasury bills roll constantly. Notes roll every few years. Each rollover exposes the system to prevailing rates. When rates rise, the cost increase is immediate and mechanical. And there is no buffer, there is no gradual adjustment. The budget absorbs the shock directly. This creates a paradox for policymakers. Inflation calls for higher rates, but higher rates worsen fiscal stress. Fiscal stress pressures the central bank to cap yields. Yield caps weaken the currency and stoke inflation. The system oscillates between these forces without resolving either. This is not a failure of intelligence. It is a structural constraint. Historically, governments escape this trap in one of two ways. They grow out of it or inflate out of it. Growth requires productivity, gains large enough to exceed interest costs. That is rare at this scale and demographic profile. Inflation requires keeping nominal rates below the true rate of inflation for extended periods. That erodes the real value of the debt, but transfers the cost to savers and wage earners. This is why real interest rates matter more than nominal ones. If inflation runs at 5% and the government borrows at 3%, the real value of the debt shrinks by 2% per year. This is not a theory, it is arithmetic. Over a decade, it liquidates a substantial portion of the debt burden without default. But it comes at a cost. The cost is borne by anyone holding cash, bonds, or fixed income claims. This process has a name: financial repression. It is not announced, it is not debated openly, it is implemented through policy alignment. Rates are kept lower than they would be in a free market. Regulation channels savings into government debt. Inflation is tolerated above target. Over time, the debt becomes manageable in real terms while private wealth quietly erodes. The danger is not hyperinflation, that is rare and visible. The danger is controlled erosion, a slow bleed that is politically survivable but economically corrosive. At 4 to 5% inflation sustained over a decade, purchasing power is cut nearly in half. This is enough to materially reduce debt burdens while avoiding panic. It is the path of least resistance, but this path has limits. As interest consumes more of the budget, flexibility disappears. Defense, infrastructure, and social programs are squeezed. Political pressure intensifies. The central bank becomes more reactive. Each attempt to normalize policy triggers market stress. Each market stress forces intervention. The feedback loop tightens. This is why volatility has increased across asset classes. Markets are no longer responding to fundamentals alone. They are responding to policy expectations. Rate cuts are cheered not because growth is strong. Once a system enters the interest trap, the debate shifts. It is no longer about whether the debt is sustainable in theory. It becomes about who absorbs the cost in practice. Governments cannot escape the math. They can only decide how the burden is distributed. And historically, that burden is never carried by the state itself. It is transferred outward, quietly and persistently, to savers, workers, and institutions that cannot easily exit the system. This is where the discussion often becomes emotional, but it does not need to be. The mechanics are well documented. When refinancing dominates fiscal policy, governments favor stability over truth. They suppress volatility, manage yields, and rely on inflation to do the work that politics cannot. This does not require extreme inflation. It only requires inflation to run slightly above interest rates for long enough. Over time, that gap does the heavy lifting. The result is a slow redefinition of what saving means. In the post-war decades, saving in cash or government bonds preserved purchasing power. Today, it does the opposite. Cash loses value steadily. Bonds return principal, but that principal buys less. The loss is not obvious because it is spread over years, disguised as normal price increases, higher rents, and rising living costs. But the effect is cumulative and irreversible. This is why the concept of a risk-free asset is quietly dying. In a fiscally constrained system, safety is no longer about nominal certainty. It is about real outcomes. An asset that guarantees repayment in depreciating currency is not safe. It is predictable loss. The state honors its obligations, but changes what those obligations mean in real terms. At the same time, the structure of regulation reinforces this outcome. Banks, pensions, and insurers are incentivized or required to hold government debt. These institutions cannot easily opt out. They become transmission mechanisms. Losses at the sovereign level are socialized through retirement systems, insurance products, and long-term savings. The cost is spread so broadly that no single group can resist effectively. This creates a widening divide. Those who hold assets that reprice with inflation, such as real estate, equities with pricing power, or scarce productive assets, adjust. Those who rely on fixed claims fall behind. The economy becomes increasingly polarized. Asset holders experience inflation as growth. Wage earners experience it as erosion. This is not ideological, it is structural. Over time, policy language adapts to normalize this environment. Inflation targets are reframed. Terms like transitory, neutral rate, and financial stability take precedence over purchasing power. The goal is not to eliminate inflation, but to manage expectations around it. Stability becomes defined as avoiding crisis, not preserving value. This is why the endgame is not dramatic. There is no single announcement, no default, no reset button. The system simply evolves into one where persistent inflation is accepted as necessary. The debt is never paid down in real terms. It is diluted. Refinancing continues. Interest costs remain manageable because real rates remain suppressed. The machine keeps running. For investors and savers, this reality forces a change in behavior. Traditional advice fails. Holding cash is no longer conservative. Buying long-duration bonds is no longer prudent. The question is not how to avoid risk, but how to avoid guaranteed loss. This is a fundamentally different environment from the one that shaped financial norms over the past 40 years. None of this requires collapse. In fact, collapse would be counterproductive. The system functions precisely because it avoids visible failure. Markets remain open, payments clear, institutions operate. The pressure is internalized rather than released. The burden is diffused rather than confronted. The debt clock will continue to rise. 38 trillion will become 40. 40 will become 50. The number will shock. Commentators will argue. But But the real story will remain unchanged. The refinancing engine will dictate policy. Interest costs will constrain choices. Inflation will do the work of adjustment. Understanding this is not about predicting disaster. It is about recognizing the regime. A regime where money is a policy tool, not a store of value. Where stability means managing decay rather than preventing it. Where the greatest risk is not volatility, but complacency. The United States is not unique in facing this challenge, but its position at the center of the global system magnifies the consequences. The decisions made to manage its debt ripple outward, shaping markets, currencies, and capital flows worldwide. The debt is not just a number, it is a structure that rewards those who adapt and punishes those who cling to outdated assumptions. The question is no longer whether the system will change. It already has. The only remaining question is whether individuals recognize that shift before the cost becomes unavoidable.